Hi, this is Alan Gassman. I'm here with Brandon Ketron and Kevin Cameron, and we are going to talk about the recent changes to the PPP loans. Some of you don't know who we are. You've been lucky. Brandon and I are tax and estate planning lawyers in Clearwater, Florida, and we just learned all about the PPP loan program. We've written a lot about it. We've spoken a lot about it, and we've had a lot of help from our friend Kevin Cameron. Kevin is a CPA in Tampa, Florida. Kevin invented a spectacular spreadsheet that we've been using that really thousands of people have been using to track how to handle these PPP loans. Spreadsheet information is on page 2. Webinars about how to use the spreadsheet and how the PPP loan works, which are free, are on page 3. Lineberg Information Services is going to have a more in-depth talk Friday, September 4th on this from 4 to 5 p.m. That's not so free. Sorry, but you get Brandon and Kevin without me. It's worth it just not to have to hear me for an hour. Page 6. Here's the big news. Here's the top of the glacier. Number 1, a shareholder who has less than 5% ownership will not have to worry about the limitations that otherwise apply on compensation. So if I have a shareholder with 6% ownership and I pay them $46,000 in compensation during the 24 months, I can only count a very small portion of that, $20,833. But if they are at less than 5%, I don't have that issue. So that's going to help some people. Brandon and Kevin are going to go into a lot more detail on that. Secondly, rent expense. If you pay a lot of rent, but someone is paying you to share the space with you, then that amount of rent that's attributable to the sublease arrangement or the expense sharing arrangement cannot count as a forgiveness expense. That makes sense. Number 3, related party rent. This is completely unfair. I have a law firm. My law firm is a borrower. We pay rent to an LLC owned by my wife. We pay the same amount of rent that my competitor pays to a similar landlord, only a landlord much kinder than my wife. That competitor of mine gets to use the rent towards forgiveness. I can only use the rent for forgiveness to the extent that my wife has interest expense on a mortgage on that building that was entered into before February 15, 2020. We have no idea why they decided to punish people like me who rent from their wives, but that's just the way life is. That's what happened. Number 4, mortgage interest paid to a related party. One of the forgivable expenses is interest expense. Now they're saying if I borrowed the money from my uncle as opposed to the bank, I can't use that as an expense. So that is the big picture. Brandon, Kevin, anything to add to the big picture description there?
Alan, I think the most important thing to remember now is that for an S corporation, we technically have 2 different ownership issues. We have the traditional 2% owner issue with respect to the shareholder health insurance. So if you're a 2% or more shareholder, you still have to include your health insurance in your compensation. So depending on how much your compensation is, let's say you go to the 24-week covered period, that 2% shareholder wage cap now is $46,154, far greater than the $20,833 cap, but their health insurance can't be added onto that $46,154 cap. So the total comp is still capped for a 2% shareholder, whereas a non-2% shareholder, we could take their compensation up to $46,154 plus their health insurance. So that's probably the biggest change with respect to the SBA finally telling us what an owner employee is. So that's one thing I'd point out there.
Now, one thing I'd like to say to clarify, because we get a lot of questions, people send us a lot of emails, and Kevin answers them all. Brandon and I might answer one or two occasionally. Just because you have the expenses that we're showing on this page under 2, 3, and 4 doesn't mean you can't get your entire loan forgiven. If you're spending money during the 24-week period, or however long it takes you to get there, up to 24 weeks, but not beyond December 31st. If you're spending that money on payroll, you're spending that money on employment taxes, you're spending that money on pension, you're spending that money on utilities, you're spending that money on other interest. As long as you spend enough and you meet the 60% threshold, you're going to get full forgiveness. For most of you, it's just going to take you a little bit longer to get there.
And Alan, I think another important point to mention there in relation to that 60% rule is there's nothing that says your ratio has to be exactly 60% payroll cost and 40% non-payroll cost. You can spend the entire 100% of the loan strictly on payroll costs and still have the entire thing forgiven. I think that's been one point of confusion, is a lot of people think it has to be exactly 60-40, and that's not necessarily the case. So some of these rules may not even apply if you can spend it all on payroll.
I think the hardest part about these rules, Alan and Brandon, that just came out on the 24th, is they're a little bit toothless, because if you're a borrower that now has a limitation, say on the rental side, maybe you just push your covered period out a little bit longer to include more payroll. So the SBA issuing these so late in the dance doesn't really seem to make a lot of sense. I think it's going to harm the borrowers that can't spend all the money. And there are some borrowers that fall under that category. And that's something, Brandon, you and I are going to talk about next Friday. But if you're in a situation like that, then it could definitely harm you, because if you had related party rent that you were relying on using PPP money for, you might not be able to any longer, or the amount might be far less than what the rent was. But otherwise, I think it's just going to force a lot of the borrowers to maybe extend their covered period out a little bit further in some cases.
Right. So I guess businesses like bars and restaurants that are closed down and really have not been able to reopen, they had lease expense, they had mortgage interest expense. They just can't write it off if they fall into this quagmire. Brandon, do you want to lead us through the Forbes article that we recently put out, which begins on page 5, which you can pretend is page 6, and walk us through what you'd like to discuss?
Yeah, so I think I'll just go to the next part of this and talk a little bit about this 5% rule and how it applies and what it really affects. So if you're considered to be an owner employee, which we now know is a 5% or more shareholder in an S or C corporation, you have a compensation limitation that applies, where your compensation paid to the owner that you get credit for forgiveness of can exceed $20,833, or 20.833% of what you were paid in 2019. That's if you use the 24-week period, or around, greater than 11 weeks. If you use the 8-week period, those limitations are $15,385, or 15.385% of your 2019 compensation. In addition to that, your retirement plan contributions, they're going to be limited to 20.833% of your 2019 contribution amount if you have 5% or more. If you're less than 5%, then these limitations don't apply. You're treated just like a normal employee, where you can pay up to $46,154 of compensation. Your retirement plan contributions are not limited. You can count health insurance in addition to that. As Kevin mentioned, though, if you're a 2% or more shareholder, so between 2 and 5, you have a slightly different rule that can apply. But that is the main thrust of this rule. Now, I think the tricky part is they didn't provide any exception for partnerships. So if you're a 1% partner in a partnership, you're still subject to the owner rules that apply to partners in a partnership, which provide that your forgiveness can exceed 20.833% of your 2019 net earnings from self-employment. Basically, your K1 income that you received from the partnership is what they're really looking at there for these partners in a partnership, and maybe some guaranteed payments if you receive those as well. But there can be limitations that do apply for less than 5% members of a partnership, because they didn't get the benefit of this rule that applied. So we had that broken down a little bit differently here on slide 8, just talking about if you're an owner-employee, that 5% or more owner in an S corporation or a C corporation, your compensation is limited to these amounts here in the 2 boxes, depending on which covered period you use. If you're a non-owner employee, that's less than 5% of an S corporation or a C corporation, then the limitations are slightly different here. It's up to $46,154 for the entire 24-week period. Now, if you're somewhere in between 8 weeks and 24 weeks, we think you prorate out that compensation. So let's say you're at 20 weeks, it would be 20 divided by 52, multiplied by $100,000, which is what they base all of these limitations off of, $100,000 annualized. So your compensation will be somewhere in between that $20,833 and the $46,154 cap that applies. On slide 9, we have it broken down between what different types of expenses you can count, whether it's health insurance or retirement plans, and the particular taxation that applies to the type of entity, because there's different rules for each type of entity. So for group health insurance, if you're a sole proprietor, owner or employee, you don't get any credit for health insurance, because if you have no employees, there's obviously no expense for health insurance. If you are a sole proprietor with employees, you can't count what you pay for your insurance, but you can count what you would pay for employees' insurance. For partners in a partnership, again, no credit for health insurance and also no credit for retirement plan expenses for the owner. You do get credit for what you pay on behalf of employees, and there is no threshold for this. So any partner in a partnership, 1%, 0.0001%, you're going to be subject to these rules and no credit for health insurance or retirement plan expenses. Now, for S corporations and C corporations, the rules are slightly different. For group health insurance expenses, for a more than 2% shareholder, you're not going to get any credit for those, even though you're less than 5%, but because you have more than 2%, those health insurance expenses are reported in your W-2 compensation. So they're included in that cap that applies to compensation, and you don't get any additional credit. For retirement plan expenses, for a more than or 5% or more owner of an S corporation, it's limited to what was paid essentially in 2019. You get 20.833% of that 2019 amount. Same rule applies there for C corporations owners, 20.833% of the 2019 contribution amount. For C corporation owners, even if you have more than 5%, you can still count your health insurance expenses, and you can still count retirement plan expenses subject to that cap. Less than 5%, you're treated just like an employee, where you can pay whatever you pay or incur during the 8 or 24 weeks for retirement plans, as well as health insurance, with the exception that between 2 and 5% shareholder in an S corporation is subject to the different rules that do apply to S corporations, where health insurance might not be included. Alan or Kevin, anything additional to add here on this chart on the different areas and what we can count?
No, I think Brandon, the most important thing to remember here with respect to the 8-week cap is that nothing has really changed for the 8-week cap. We're really, the main change is really for the people who go beyond the 8 weeks and up to 24 weeks.
Yeah, I agree. All right, so next slide here on slide 10, we have the second rule that they've changed. And what this rule provides is that if you have a sublease space or you're sharing space and another business is really paying for a portion of that space, then you only get credit for what you've used towards your business. And the rule is a little hard to understand, but the examples really do a great job of laying this out for us and really showing us how the rule works. So for example here, if you have a $10,000 a month building that you're paying rent for, but you sublease out that for $2,500 to another tenant, well, you only get credit for the $7,500 that you pay for the space that you use in your business. You're not going to get to count the full 10 And that makes a lot of sense. And then the same thing applies to mortgage interest, where if you do sublease out of space or you share space and the sublease space is 25% of the building, then you can only count 75% of the mortgage interest on the building, because that other tenant's going to be counting the 25% with their PPP loan and towards their forgiveness. So they're not going to let you double count. And this makes good sense and matches things up. And I think a lot of people were probably looking at it this way to begin with. And in the final example here, they did provide guidance on if you work out of your home, to the extent that you can deduct the expenses for your home office on your business tax return, you can go ahead and count those expenses towards forgiveness for mortgage interest, for rent payments that if you paid any rent, for utility type payments. If you're not deducting them on your tax return for your business, they're not going to be counted towards forgiveness. So Kevin or Alan, anything to add on this rule?
No, I think you covered it very well, and I think the SBA did a good job of writing this one up. There's not that much to question on this one.
Yeah, so now we get to the real fun part, the related party rent and the related party mortgage interest. They have changed the rules here now more than 5 months since the passage of the CARES Act, that provides that if there's any type of common ownership between the entity that is receiving rent, that you cannot count the rent paid to that related party unless that related party has a mortgage on the building or the asset and they're paying mortgage interest. So it counts to the extent that mortgage interest is paid. So if you have a $10,000 rent payment, the entity holding the building has $1,000 of mortgage interest, you get credit of $1,000 towards the rent, not the full $10,000 that you paid. If the building's completely paid off and you're paying rent over to that entity, you don't get any credit at all for the rent paid to the related party. And I think it's pretty penal too that they provided that it's any common ownership. It's not 50% or more, it's any ownership. So if you have 1% ownership in the company that's receiving rent, it could screw up the whole thing. And I think though one of the, I guess, unanswered questions here is they really didn't provide for any attribution rules or any family attribution rules. So in Alan's example earlier, where he pays rent to his wife, that might be okay because Alan doesn't own the building or doesn't own the LLC that's receiving the rent payment. His wife does, which is a different person than owns the law firm. So we're not really sure if they're going to apply family attribution, but that is one potential unanswered question there. So Alan, Kevin, any additional thoughts on this?
Yeah, Brandon, I think you hit the nail on the head as far as that's concerned, because they were very specific to mention that any ownership counts as common ownership and therefore makes the rent not includable. And I've seen that's probably been the number one question I've fielded in the last couple of days is, where there's a partner that owns a building, but then there's 10 other partners that don't own the building. So now those 10 partners don't really get any benefit of the rent paid to the entity that the one partner, owns the building. So it is kind of arbitrary and almost unfair to a certain degree. But you would think that if the attribution rules were going to be applied, they would have certainly mentioned it by now. They would have said any family member or related party, and they didn't. So I'm kind of erring on the side of reading the IFR literally, but I would expect that maybe 5 months from now, we'll hear the SBA finally tell us related parties have to be included.
Yeah.
What do they define related parties?
They don't define a definition. We have the exact language here, and I'll just flip to it so we can talk about this issue. But you'll see here on slide 18, they say, I'm trying to see where it is, any common ownership between the business and the property owner is a related party for these purposes. And that's all they say. They don't say any common ownership under attribution rules that apply under the numerous attribution sections we have in the Internal Revenue Code. It's just any common ownership in common between the business and property owner.
So if I divorce my wife before the end of the 24-month period, does the rent paid before we get divorced count or not? Because this is very important to me to know.
Yeah, I don't know, Alan. I think that is one of the unanswered questions here. Is a spouse considered to be related for purposes of this rule? Are children considered to be related? What if you have a trust that owns the building and you pay rent to the trust? What about tiered entities? Maybe you have some sort of entity in between your ownership and the individual. Is it attributed up through the entity, or is it block the related partiness? It's a little unclear, and hopefully they would clear this up in future guidance, or maybe just revoke this rule altogether. We'll just have to wait and see.
Well, I think two things. One, this is an example of why our clients need to file their forgiveness applications as soon as they can before more silly rules like this come out. The second point is, Brandon, right after this webinar, you need to call Marcia and explain why we need a quick divorce so that I can get this rent off. Okay.
I think another question here too is, when is the ownership relevant? Is it at any time at all during the covered period? What if you sold the building and for half of the covered period it was owned by you and half of the covered period it was owned by someone else? Are you prohibited from counting all of it, or just the time that you owned it matter? It's really unclear, kind of poorly drafted in my opinion, to be such a rule that affects a lot of people, to have such vague language.
And I think that what's going to happen is a lot of the borrowers are going to just, if they've got any question with respect to this issue, they're going to exclude the rent and they're just going to add more payroll, like I mentioned earlier. I think that's the trend we'll see. And Alan, you mentioned getting your application in sooner than later. And the real problem we're having there is a lot of the lenders are still not taking those applications. I've had about 10 lenders kind of accept a paper application from a borrower because the borrower wanted to submit something. In 3 of those cases, it was because there was a business sale involved. In 1 of the cases, it was because there was a business closure involved and they were worried about the FTE issue. But I think that, that's why I mentioned earlier that some of these rules here, while they are very negative in my opinion, they might not be that relevant anymore. We might just have to wait a little longer to increase our other expenses.
Yeah. And we've talked a lot about rent on this, but another part of this rule is, and you can see it here, it says, while rent and list payments to a related party may be eligible for forgiveness, mortgage interest payments are not eligible for forgiveness to a related party. So if you have related party debt, then that's not going to count at all towards your forgiveness. And again, the same questions apply to that. It's any ownership in common, so as little as 1% can cause it not to be counted. And again, we're uncertain if there's any type of family attribution that applies to cause that rule to come into effect.
Yeah, that's probably the most disappointing line in the entire IFR, because a lot of companies, a lot of owners will end up lending money to the company because they've got they treat it like an investment, and they do get a return on their investment. And Alan, we work with a lot of people that do these kinds of arrangements, and most often the interest is an arm's length transaction to keep everything straight with IRS reporting. So there isn't any reason why that interest shouldn't be counted. That's probably one of the most disappointing things we've learned in this IFR.
Mm-hmm. Yeah, and then if you don't pay the interest, then you're going to be treated as having paid the interest under the Internal Revenue Code. So you're going to get hit twice.
Yep. And the sad part about that is, if your business is struggling right now, that might not be even a possibility. So it is not a good thing.
Right.
Anything else you want to cover?
No, I think the most important thing, Alan, is to remember that these IFRs didn't change the math, like the formulas and so forth. It just changes how you input the numbers or what numbers you get to count. So if you're in process, like I walked through the calculation with a company in Georgia yesterday, where they had several $100,000 in related party rents. And so now we had to peel that back to what the underlying interest was on those rents. And we went from several $100,000 in the expense tracker to about $80,000 of actual interest expense they can count now. So then we looked at how much more payroll did they need to include to be able to still get full loan forgiveness. So I think this IFR, if it did anything, it just kind of made us have to rethink how we're going to present and calculate the loan forgiveness. I spoke to 2 businesses yesterday that said they're done with this. They're going to exclude all expenses, but only include payroll, and they're just going to pay enough payroll until they're paid out of the loan. Some of them have already done that, and they're going to simplify their forgiveness application because all they're going to need to provide is payroll data now. So I think some of these small businesses are really kind of getting fed up with this process. We've had a Congress that hasn't done its job to provide better guidance. We've had an SBA that, while I have to give them credit for the fact that they've been incredibly overwhelmed, but they've also really not done as good a job as they probably could have done to help, you know, these 5.3 million small business owners. So hopefully we won't get any more bad FAQs or IFRs out of the SBA, and hopefully we'll get some legislation soon from Washington that helps us out a little bit with this, with not only a second round of PPP, but also with making it easier for some of these smaller borrowers, small loan amounts to be forgiven.
Okay, very good. Well, we thank everyone for attending this presentation. We do welcome your questions, comments, and suggestions. You do have our emails here. Do send the harder questions to Kevin, though. We hope the rest of your day is fantastic, and we hope that the Rubio-Collins bill or something close thereto gets passed so that there can be some more relief for businesses and individuals who really do need it. Thank you very much.